But beneath the surface, Mike, I'm telling you, like things aren't as bad as I think most people are making it out to see.
You mean that the market hasn't been as narrow as people have portrayed, or what do you mean by
Yeah,
that?
absolutely. So I think one distinction we need to make, particularly those who follow the charts like I do, is that the momentum of breadth has slowed. Like the percentage of stocks above moving averages and how many stocks are making new highs. Yes, those have declined over recent weeks, but the trend of breadth remains positive. So take a look at the RSP, the equal weighted S&P 500. That just broke out of about a 4 week, 5 week trading range yesterday. That looks pretty healthy to me. And even small caps, they really tried to break it down and they couldn't. So one way I've been framing it with clients at MRA is this: like, can't breadth take a breather too? And I think that's essentially what's been going on. There was a lot of good technical goodwill at the end of last year. I don't think we've negated that quite yet.
Yeah, it's interesting. I'm definitely in that camp of saying just because you can tabulate how much of the upside has come from a few stocks doesn't mean the rest of the stocks have been poor or or losing the benefit of the doubt necessarily. It's kind of like, I remember at some point along the way in high school they allowed you to have more than a 4 GPA, and the other stocks were getting B pluses even if they weren't the best students. I guess the question is, within the market, what looks interesting at this point in terms of
Sure.
emerging leadership or things to stay away from?
Yeah, fair point, right? We already know what's working. We're already focused on the shiny objects, which is the Mag 7. So what's improving? Energy has caught my eye as of late. Take a look at WTI. It looks like a nice little base formation that's forming there. You get WTI above 80, then I think the rest of energy is going to follow. Refiners have been great, but now I think the rest of energy could benefit from that. So I think it's a good source of chart diversification in one's portfolio. So start sniffing around the energy sector. The other part that I've been focusing on has been within healthcare. And it's not just Lilly that looks good. It's like the biotechs and some of the other pharmas. Take a look at the healthcare ETF. That just broke out of a, 18-month trading range. That projects about 20% higher on the charts. A lot of good, interesting names there. So that's where I think some of the fresher money could be. Look at energy, dip your toes in energy as oil's stabilized. And then also healthcare looks pretty decent.
And in terms of just, I guess, the big picture, you framed out, maybe we are kind of putting in the upper end of a trading range. If you see a pullback to 4,700, let's say, that's like 8% thereabouts from the highs. Not terrible. Those types of corrections tend to happen most years. Is that just kind of a stop along the way? I mean, where are we in the longer cycle? Because you do hear some folks assuming we're kind of in the latter innings, we're kind of stretching valuations. On the other hand, it was only a month ago we broke to a new high that had previously been set 2 years earlier. It's not as if we've really been running away to the upside for that long.
That's a fantastic question, and I wrestle with it as well. I'm talking to clients. We do try to thread that needle a little bit. A couple ways to think about it. Yes, there are some technical red flags to say, hey, look, listen, we're ready to fall into a secular bear market given how stretched the markets have been since the '09 low. I'm not in that camp, and one reason why I'm not in that camp yet, and I appreciate the AI craze and all that. I think one thing we need to remember is that transformative technologies have led every bull market for the last 100 years. Number two, I had a front seat view of the tech bubble, and you did too. And I would say the wall of worry is incredibly higher now than it was then. So I just think this is par for the course. Yeah, AI's doing its thing, but autos did their thing in the 20s and railroads did it in the 1800s. This is kind of like how things operate over the long run.
Yeah, I'm with you on that for sure. It seems as if the dominance of the Mag 7 has made people reluctant to trust the market, which kind of rebuilds the wall of worry. I guess the warning is that you may never get anywhere close to 99 anytime